Hi everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of business to find the hidden wins and losses in the world of corporate finance. So today we're diving into Gibraltar Industries' second quarter report, and let me tell you, it's got some interesting moves that we need to unpack. Alright, let's get straight to the heart of it, all the numbers. First off, looking at their income statement for the 3 months ending June 30th, 2025, Gibraltar raked in $309.5 million in net sales. Now that's a solid jump up from the $273.6 million they reported for the same period in 2024. That's a pretty big increase in sales, showing their products are selling well. This jump in net sales, a nearly 13% increase, was mostly powered by some significant acquisitions they made in the first quarter of 2025. Remember, they bought Lane Supply and 2 metal roofing manufacturers. Together, these new additions added about $50 million in sales. Even with that boost, their core business saw a small dip in sales. This means while the new companies are helping, their existing operations are facing some headwinds. Now, when we look at income from continuing operations, that's the profit from their main businesses that are still running, we see a slight decrease. For the 3 months ending June 30th, 2025, they reported $29.4 million, down from $31 million in the same period last year. And for the 6-month period, it's also down a bit from $53.9 million in the same period last year. And for the 6-month period, it's also down a bit from $53.9 million in the same period last year. And for the 6-month period, it's also down a bit from $53.9 million. This suggests that while sales are up due to acquisitions, managing the costs of those new businesses and maybe some market challenges are eating into their profits. Let's talk about gross profit, a measure of how much money they make after directly paying for what they sell. For the 3 months ending June 30th, 2025, it was $87.8 million. That's up slightly from $83.3 million the previous year. However, as a percentage of sales, their gross margin actually dropped from 30, says this is due to their mix of products and maybe some price pressures, and their trio sales, they're keeping less money after covering the direct cost. The company says this is due to their mix of products and maybe some price pressures. Then there's selling general and administrative expenses, or SG&A. That's the cost of running the business beyond the direct costs of the products, like salaries for sales teams, marketing, and office staff. This expense increased by about $5.8 million to $48.3 million for the 3-month period. A big chunk of this increase comes from those new acquisitions again. The good news is it stayed flat as a percentage of sales at 15.6%. This all leads to operating income, which is basically profit before interest and taxes. For the 3 months ending June 30th, 2025, it came in at $39.5 million, down from $40.8 million the year before. The company's different business segments showed mixed results here. In their residential segment, sales grew, but their operating margin dipped a bit from 20% to 18.9%. They attribute this to product mix and lower volumes. The AgTech segment, which includes things like greenhouses and agricultural structures, saw a significant sales increase thanks to the Lane Supply acquisition, but it swung from a profit to a loss. They went from an operating profit of $23 million to a loss of almost $500,000. This is mainly due to acquisition costs and a shift in big project timings pushing revenue into later this year. Their infrastructure segment, which deals with things like bridge components, showed solid growth in sales and an improvement in operating margin, increasing from 25.1% to 28.1%. This segment seems to be performing quite well. Overall, the consolidated income from operations for the company decreased by about $1.3 million compared to last year. Interestingly, they went from earning interest income last year to paying interest expense this year. For the 3 months ending June 30th, 2025, they had about $500,000 in interest expense. This is likely due to fees associated with their credit lines, even though they didn't have any outstanding debt. And finally, net income. For the 3 months ending June 30th, 2025, it was $26 million, quite a drop from $32.2 million in the same period last year. For the 6-month period, it was $47.1 million in 2024. This shows that while revenue is up, profitability pressures are definitely present. Now let's look at their financial health picture on the balance sheet. As of June 30th, 2025, they had $43.3 million in cash and cash equivalents. This is a pretty big drop from $269.5 million at the end of 2024. This decrease is directly tied to their acquisitions and also a significant amount of money spent on buying back their own stock. On a positive note, their credit line, the revolving credit facility, remains largely untouched. They have $394.9 million available, so they have plenty of access to funds if needed, even with a reduced cash on hand. The company's goodwill, which is basically an accounting measure of the value of a business above its net tangible assets, has significantly increased from $323.2 million at the end of 2024 to $410.8 million by June 30th, 2024 to $410 million by June 30th, 2025. This jump is directly from the goodwill created by those recent acquisitions. Their acquired intangible assets also jumped from $55.8 million to $135.8 million. These are things like trademarks and customer relationships that have value but aren't physical. The big increase here again comes from those acquisitions. Looking at how money moved through the company. For the first 6 months of 2025, their operating activities from continuing operations brought in $48.26 million. That's down from $90.4 million in the same period of 2024. This lower inflow is because they invested more cash into things like inventory and receivables, likely due to the growth from acquisitions and maybe some seasonal demand changes. Now for the big investing activity that really stands out, their acquisitions. In the first 6 months of 2022-25, they spent a massive $92.9 million on acquisitions. This is way up from $0 spent on acquisitions in the first half of 2024. This clearly shows a strategy shift towards growing through buying other companies. On the financing side, they spent $62.5 million on buying back their own stock in the first 6 months of 2025, compared to a much smaller $1.4 million in the same period of 2024. This indicates a strong confidence from the company in its own stock value. Now, a major operational change is happening. In June 2025, Gibraltar decided to sell its renewables business. This is significant because it's a strategic move to really focus on their main residential, agtech, and infrastructure segments. The assets of this discontinued business are now listed separately on their balance sheet, totaling about $369.7 million. And for the 3-month period ending June 30th, 2025, this renewables business generated $53.6 million in net sales, but actually had an operating loss of about $5.4 million. This sale is likely a move to cut off a segment that wasn't performing as well. Let's dig a bit deeper into what management is saying. They are trying to reshape key markets with new engineering and technology. Their strategy is built on 3 main things: their business system to improve performance, portfolio management to focus on growing markets, and organization development to build a strong team. In their recent developments beyond the acquisitions and the sale of the renewables business, they've also authorized a new $200 million share repurchase program. This shows they're confident and looking to return value to shareholders. Looking at the comparison of the 3-month periods, the story is clear. Sales are significantly mainly because of acquisitions, but profitability is under pressure. Their gross margin decreased, and while SG&A as a percentage of sales stayed flat, the dollar amount increased due to those new businesses. The same trend holds true for the 6-month comparison. Sales are up, driven by acquisitions, but the overall profitability, both gross margin and operating income, has declined. This is a common pattern after major acquisitions as the company integrates new operations and deals with associated costs. When it comes to their financial flexibility, their cash on hand has decreased significantly, mostly due to spending on acquisitions and stock buybacks. However, their credit line remains strong, providing a good safety net. They are investing heavily in new businesses and also returning capital to shareholders through stock repurchases. A key area of focus for them, especially with these new acquisitions, is accurately valuing the purchased assets and liabilities. They use professional valuers to get these fair values right, which is crucial for how they account for things like goodwill and intangible assets. The assumptions they use, like revenue growth and profit margins, are forward-looking and can be affected by what happens in the market. As for risks, nothing fundamentally new has emerged compared to their previous reports, according to the filing. They're still exposed to the usual economic conditions, competition, and material costs. And in terms of stock sales, they didn't have any unregistered equity sales. The main thing here is that recently approved $200 million share buyback program, which signals strong management confidence. So what's the big picture here for Gibraltar Industries? On the positive side, they are clearly executing a growth strategy through acquisitions, expanding their market presence in agtech and residential segments. The infrastructure segment is also showing healthy performance. The significant increase in their share repurchase program suggests management is optimistic about future performance and their stock's value. However, the decrease in margins and net income, even with increased sales, is something to watch. Integrating new businesses always brings challenges, and it looks like those are currently impacting their profitability. Delays in agtech projects and portfolio management actions are also creating some short-term headwinds. They've managed to do this without taking on new debt, which is good. Overall, Gibraltar Industries is in a period of substantial change and investment. The success of their recent acquisitions will be key to turning top-line growth into improved profitability. They've got a solid credit facility and a clear strategy, but they'll need to navigate the integration challenges and market shifts carefully. What are your thoughts on Gibraltar's aggressive acquisition strategy and its impact on their bottom line? Let me know in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.